Thanks very much, Sean, and thanks and apologies for you having my long introduction to my biography. So I'm going to go through some slides. Firstly, it's a pleasure to speak at the conference. I think I attended this conference before, and from the floor, someone said to me, "You were brave to come and speak about the economy to a room full of accountants." But so I'm back again anyway, and it's a pleasure to do this. What I'm going to do is I'm going to essentially cover the main macroeconomic outlook. So I'll look at output growth, and I'll delve into inflation and interest rates and talk about the labour market. And I'll touch a little bit on business resilience and show some charts around insolvency and what's happening in that regard. I think the theme for the conference is really apt around insolvency and restructuring because I feel as if we're in a moment where there's a big reset taking place in the economy. Given, I'll go on to talk about some of the kind of shocks that have hit the economy over the last period, but we're seeing from supply chains, operating models, how business use labour, and dealing with the kind of changes to input prices and stuff over that period. We're seeing that kind of reset happening across the economy. I mean, the economy changes all the time anyway, as you know, but sometimes when you have shocks or change, it heightens that process of change and brings it through much more quickly. So I've got some slides. Some of the slides are quite busy, but the slides will be available, as Sean had said. So I'll start really with the first slide, which I hope you can see okay on your screen. So this slide's really trying to think about, it's looking at recent growth in the economy, and essentially it shows gross domestic product, so GDP, the value of all goods and services produced in the economy, and essentially it shows the mean, the average growth over the period from 2000 through to 2019, and essentially it shows the upper range for growth and the lower range for growth. So that's one standard deviation. I'll explain why we do that in a second. But so GDP, it's kind of value of goods and services produced in the economy. Any idea what the nominal value of GDP in Scotland is? So it's obviously a rhetorical question, but it's 213 billion in the last financial year, 22-23, 190 billion onshore and 23 billion offshore. So that's a contribution of oil and gas. Also, you might be interested to know the structure of the economy is broadly nearly 80% services. So 77% services, 23% production and manufacturing. And finance and business services now accounts for around 30% of GDP in Scotland, having doubled over the last 40 odd years. So that's a sector that's really grown within the economy. In contrast, manufacturing accounts for about 10% of the economy. It was closer to a third in the 70s. So you can see the changes in the structure of the economy. But on this particular chart that I've put up, what I want to give a sense of is we've had a period up until the financial crisis, probably from about 1992, where the economy grew consistently for about around 1.82%. And since then, we've had two abnormal shocks. So abnormal shocks is where the lines are out with the upper and lower bound for the kind of trend growth rate. Obviously, the financial crisis was the first of those, 2008-9, and that was a significant shock for its time. And we've seen the economy recover. And then these kind of mini shocks we had in Scotland, oil and gas price fall with the EU exit vote impacting expectations. And then we have COVID. And COVID essentially, again, is off the scale in terms of the contraction in output and the response over that period. So you can see where we kind of are now, where the kind of line has come down. The forecasts for growth, most recent forecasts are for the economy to grow barely this year, around 0.3, 0.4% in 2023, but then improve again in 2024. Over this period, the kind of average growth in Scotland's been about 1.5, 1.6%, the UK about 1.8%. But what we've seen is a marked slowdown really since the financial crisis and the impacts of that post. So it's worth just bearing that in mind in terms of kind of business resilience. It's been a much more difficult period for business post-COVID, and now obviously we're dealing with the cost of living crisis and the impact that has. It's worth also saying that so we're essentially in a low growth environment with forecasts growth barely above zero for this year and next year improving. But even in that context, there's a positive there in the sense that given the forecast last year, the mood actually this time last year, OBR, Bank of England, were forecasting really a recession during all of 2023, a 6-quarter recession, which hasn't materialised because consumption's held up the more and business have been more resilient in that context. So that was by way of some historical kind of context. What will be interesting with the cost of living crisis is this a shock that's within the bounds? So it'll allow for a quicker recovery in that regard. So just looking at some Scottish data, more specifically, the chart to the left just shows quarterly and annual growth in Scotland. The red line is annual growth, and you can kind of see that close to the zero line in terms of output. The actual numbers over the year to Q2 were economies down 0.2. It grew by 0.2% in Q1, contracted by 0.3 in Q2. Though the story's in the detail really, because some sectors have continued to do well. Finance and business services, for example, has grown by 1.1% over that period. Consumer-facing services such as retail, parts of the hospitality sector have obviously been more hit. And the other chart accompanying this just gives the breakdown between the red line is services, and then you have construction and manufacturing. And you see really manufacturing still kind of struggling, both with supply chain and input price issues. But as I mentioned, some parts of the economy have done well: energy, banking, financial services. Some of our key exports, food and drink, continue to remain really strong, tech, digital, and we're seeing that reflected in companies coming to Scotland and investment and stuff. But on the output side, it's essentially a low growth environment at the moment. This is the next chart, essentially just picks up on the most recent data. It's PMI data for Scotland, so published monthly, Purchasing Managers Index. Growth above 50 suggests the private sector is growing. Below 50, it's contracting. So you can see the kind of slowdown as we've continued through this year, and the breakdown between kind of new orders and output still continue to be a drag on the economy. So that's kind of covered output quite quickly, and I'll come back to output at the end. I'm going to now look at inflation and interest rates and what's happening in that regard. So 2 charts here. I really like these charts, particularly the interest rate one. It's really quite extreme, both the drops up and coming back up. So where are we with inflation, first of all? So peaked at 11.1% in October last year, highest level for 30 years, and probably a bit of a shock to a lot of businesses that hadn't dealt with that type of price change for a significant period. Inflation currently is down. July was 6.8%, down from 8.1% the previous month. And actually we get the next inflation data on Wednesday, and the next Bank of England interest rate decision is on Thursday. The chart, so inflation down at 8.1%, core inflation remains at 6.9%. So again, that's something that's something that the bank will look at in their determinations. If you look at the interest rate chart in particular, so interest rates 5.25%. We've seen, I think, 11 consecutive increases in interest rates, a real tightening of monetary policy. And for me, again, this gets back to the kind of reset theme. It's the start of that kind of reversal of the quantitative easing that we've seen from the financial crisis that was continued through the COVID period, supporting both the banks in terms of liquidity, keeping long-term interest rates low. And there was always going to be a time when the Bank of England would look to reset to a kind of more normal level. I think the surprise impact of inflation has meant that came quicker than was previously thought of. So with interest rates obviously rising, we're reducing demand in the economy, we're hitting consumption, but they're also supporting sterling, so you're reducing some of the imported inflation. And this isn't a UK phenomenon. Obviously, the US Fed have started increasing interest rates before the Bank of England, and so have other central banks. So the Bank of England, in that sense, is in line broadly with the trend that's been happening both by the US Fed and the European Central Bank. But in terms of the business and wider context, obviously inflation has distributional impacts, hits people on fixed income, lower paid, those most exposed. And the transmission period for interest rate rises come through to the real economy. It's probably about 18 months. We know that a number of people still have fixed rate mortgages, and that period will continue. That will continue to change that. The higher inflation also hits UK government debt. The interest payments doubled over the last year due to the kind of the index-linked debt that they have within the portfolio. Worth saying also, and I know you know this, that though inflation has fallen, so the rate of change in prices is coming down, the price levels remain elevated, 20 to 25% above where they were prior to this shock. So it's still a big shock. Inflation's forecast to come down by the end of the year to kind of just below 5%, and next year kind of coming down by the end of the year to 2.6%, but it's probably 2024, 2025 before you get back to where you are. Worth just saying a couple of things about the bank's response. So the nature of the inflation shock has been mostly supply. So the energy input prices, some of that was obviously linked to COVID, some of it linked to pent-up demand in the economy, obviously exacerbated by the war in Ukraine and the surge in commodity prices that we've seen there. The bank's concern is really about the second round effects and price expectations becoming embedded through pay awards, and the general prices moving as energy prices are coming down, being reflected in broader prices across the economy. For the business sector, essentially you're facing increased input prices that have been much, much higher than some of the inflation recorded here. Input prices annual growth was about 25%. It's come back down, but again, that's elevated levels. And for businesses, you either absorb or you pass on. And I think what we've seen is a combination of both. But I'll come back to that at the end. I'm going to say a little bit about labour market and the earnings now, and then I'll kind of keep going through. So interestingly, when you would have typically when we have interest rates rising, a slowdown in growth, you would usually expect to see the labour market softening, unemployment rising, and that would be a kind of downward pressure on pay. We're seeing the opposite at the moment. Essentially, the labour market remains really tight. Though vacancies and demand for permanent jobs are easing, it's still difficult to recruit across key parts of this economy. It's almost, I think, 40% of businesses are having difficulty either finding people with the right skills or recruiting. So that's a challenge and a pressure. Unemployment in the economy, 4.3%. The most recent data still historically really low. Anything below 5% is kind of close to full employment. The employment rate around 75% and inactivity around 21%. But so by historical standards, really strong. But what we're seeing in the labour market is really a kind of supply side shock in the sense that there's less labour available. We know from the data we lost around 1 million EU workers with EU exit, compounded by COVID. And in Scotland, that's around 80,000 less workers in that regard. A lot of those workers would have been employed in the sectors most impacted by labour shortages at the moment. I'll show a chart on that briefly. I think the chart on pay is more interesting, actually, the one on the right-hand side. So essentially, this is what we're feeling in the economy. The red line essentially shows the real growth in pay. So this is nominal median earnings in Scotland, which are roughly about £2,300 per month, 28,000 per year. And what you show, what the kind of blue line shows is the nominal growth, and the red line, the real growth. So what's interesting is there's 2 points here. Obviously, we've had a period of a real term squeeze in households' income through pay. Everybody's felt that. Inflation maybe didn't reflect the impact of the energy rises as fully last year as people felt. But what's interesting is the period prior to that actually the period of real terms growth during the COVID period, where we've seen wages rising. Again, this linked to this supply side shock with little or no inflation, but those gains are essentially wiped out at this point, and we've seen that reversed. What's positive here is we're now seeing positive growth. The most recent data, there's 3 data points showing earnings growth above inflation, and that's really positive for confidence and the economy. So I've covered very quickly kind of output, inflation, the labour market, kind of changing labour market conditions, and uncertainty. So I'm going to give some quick overview of some of the business data and perspectives, and then I want to kind of take a few moments at the end to kind of sum up, if I can, a little bit about what it kind of means, I think, and what we're likely to see going forward. So again, another kind of busy chart, but this one I'm just reflecting the point I made about labour shortages in the economy. All businesses reporting around 39% of businesses reporting difficulties recruiting. The kind of bar charts show that most more difficult in construction, hospitality and stuff. And I think this is, if you think about the COVID period and what we've seen during the COVID period, how businesses had to adapt their business models due to the limitations in terms of how they could operate during COVID. And I think we're seeing that continuing, particularly in hospitality, where businesses are operating when they deem it profitable, or when they have when they need the staff. So it's a different type of model, much more flexible in that sense. So I'm going to now just carry on through some of these other charts. So I'm interested in your views on this as well, in the sense that the extent to which the business sector has remained resilient. My own sense is that part of the business sector is resilient, partly to do with the period that they've came through, partly to do with the COVID and the support, access to finance, such that we're seeing cash reserves, holdings were boosted during that period, much more flexible in terms of business models and business practice, changing how they operate, how they use labour. And that, I think, is reflected in the kind of the business resilience in that regard. This slide picks up on insolvency. It's about insolvency risk and insolvency data, and the main line in the chart to the left kind of shows the insolvencies. If you take out the kind of COVID dip, then essentially you've got a slightly upward trajectory, not much. But what's changed is obviously the composition in terms of insolvencies, which you will know are the changes that have kind of driven that. The business view around the risk of insolvency is fairly stable, not really peaking up or anything. So again, this notion that businesses are actually coming through this reasonably okay. So this slide is looking at just again self-reported data from businesses in Scotland up to August, looking at cash reserves and uncertainty for business. So what we see really is cash reserves for business remain relatively strong. Though there's more uncertainty for businesses, but they're still relatively resilient. And I think that's what we see in terms of the cash within the holdings within banks and stuff. Businesses are still holding cash at this time, particularly where there's uncertainty in the economy. So I've got kind of a couple more slides, and then I'm going to kind of sum up what I think it kind of means. This slide is our Scottish Government. We produced this slide in relation to essentially household confidence. It's a barometer of household confidence, consumer sentiment. And what you can see is essentially the impact of where we are now. It's becoming less negative, but it's still there. We survey 1,000 households roughly every month. We ask them both about their own financial outlook and their outlook for the economy. They tend to be more positive about their own financial position, but less positive about the economy. And that's important because expectations impact in spending patterns. And the other chart's a GB-wide chart that just shows essentially how households are responding to the squeeze on income in terms of how they're changing their kind of business models and patterns. So again, another busy chart, but hopefully I can bring some life to it. So the Treasury publish each month the average of all the independent forecasts for both output and inflation in the economy. And it's quite a good indicator of both the kind of change in mood and the overall view. What you can see in the output chart, so the blue bars are 2023, the yellow bars 2024, is that essentially the outlook for this year was negative, but has improved as the year has gone on. So we've gone from that kind of concern about contraction now to essentially a low growth environment, and the outlook for next year remains broadly positive as well. The kind of average for 2023 now for the UK and Scotland is about 0.3%, so it's not not much growth, but not recession, improving next year to about 0.7%. Again, similarly with inflation, you can see the change in views. Inflation expected to kind of finish around 4.4% 2023 and get down to 2.6% in 2024. So that's quite a period of adjustment. So just to kind of sum up, if I can, some final thoughts. So quite I suppose in one sense you could say quite a gloomy presentation, looking at some of the data that I've presented, though in the context of the shocks that have impacted the economy has remained resilient both in Scotland and the UK, and also that with below the data there's a lot of different changes at the sectoral level, and actually that whole sometimes the opportunity created for business and to change business models can be really quite positive. So on the positive, we're kind of through much of the adjustment. The mood music this time last year was much more negative. As I mentioned, inflation peaked last October. It's coming down. We'll get the next data on Wednesday. It's probably going to be sticky coming down, but it's coming down. So that's positive. Though the impact of interest rate rises is not fully reflected in household spend. Again, contrast that with this time last year where we had OBR and Bank of England kind of forecasting recession. For households, it's really about income, cost of living, the confidence and the resilience of their income. And I think given the strength of the labour market, even though it's softening, we're still seeing that there, and we're still seeing reasonably strong pay growth. The most recent nominal pay increases was something like 8.1%. So that's why we're seeing that. So there's that. Those only 3 data points. That return to real growth is really, really important for people at least feeling that this part of the adjustment is partly over, though obviously they'll have costs in other parts of their household through higher mortgage or credit-related issues. For business, I think it's really interesting in the sense that they've faced a number of challenges and shocks. COVID was obviously massive. The price shock is a different type of shock. It brings a different it brings kind of different challenges when you're facing those pressures and input prices, and how you deal with that, the extent to which you're able to pass it on, or the extent to which it squeezes profitability. I think marry that alongside the challenges around labour, and we must see kind of changing business models. That's essentially what's happening in those sectors most impacted. The economy overall has remained resilient. Not at this point, but not all sectors are impacted to the same extent. We've seen energy in particular, energy sector, oil and gas and related being really profitable. The banking sector obviously coming back given the interest rate margins, and broader financial services. We've seen upsides around tourism coming back, overseas visitors to Scotland, again reflecting the lower value of sterling. And we're seeing kind of record levels of inward investment continue to come in. So that's all kind of positive and adds to the resilience. I think just finally, so for government, the challenge obviously, cost of delivering public services, pay, that's an issue for Scotland, obviously, cost of pay deals and settlements. For the UK, obviously, as well, the cost of servicing debt, as I mentioned, had doubled over the last period. And finally, the Bank of England on Thursday will decide on the next interest rate change or not. For me personally, I think they're at the end of the rate rising cycle. I think the last committee voted 6-3. Inflation data is out on Wednesday. It might not come down much, but I think it's kind of diminishing returns now in interest rates, and I wouldn't be surprised if they then hold them. the counter argument is you do one more 25 basis point rise, and then you signal that's the end of the cycle. But I wouldn't be surprised if they hold. The final kind of thoughts. Usually when we have periods, if you go back to the very first chart I had where the economy kind of output increases and then decreases, we would usually think of those as kind of business cycle corrections. And I think thinking about the current period in that way isn't a kind of bad way. So business cycles maybe being over exuberance in a particular sector, over investment, the price or model is changed, and you get that correction within the sector. And for me, this feels like a business cycle correction. And the business cycle correction is usually what you see as you see more resilient businesses coming out of it, improved productivity at the end of it. So for me, I kind of see an upside possibility in 2024, given the resilience of business and given that kind of the opportunities that are still remain. And finally, I suppose for Scotland, we know energy, green investment. We've seen the ScotWinds round, real interest in investment overseas and indigenous, real opportunities around the green industrial strategy to build and capture the value added on that chain. We have good businesses. We have really strong international companies that continue to export and do well. There's good investment opportunities across Scotland. We've got a strong university capability. We're seeing new emerging sectors in tech, digital, alongside the traditional kind of sectors. So though we've had a difficult period in the sense of the kind of shocks that are there, the economy remains resilient. And I would think in terms of I know you know the detail of sectors, think about it as kind of sectors correcting and the positives that can come out of new business models, technology, and new patterns. So I've left, I think, 6 minutes for questions. So I will pause there, and I'll leave the slides are there to end. So I'm not going to talk to this last slide, and I'll come back to Shona.
Thanks for that. We've got a question, and I think you touched on it a little bit just in your summary there. But it's about if we've got it's around the challenge for growth, coupled with the high employment. I think I read this morning that highest employment for 50 years, and I think it just seems to be hovering about that over the last wee while. So yeah, just where do you see the opportunities are for growth?
Yeah, so I think in a sense, there's a number of opportunities, both sectoral and within the kind of what usually drives growth is changes in business models, new technology, the type of things that we would expect. I think if you were looking for a positive external story for Scotland, it's really about probably green investment, green industrial strategy, the opportunities for companies to come in, opportunities for supply chains. In that, the challenge is we've still got a strong oil and gas sector, and do we have the skills to manage that transition? But there's loads of opportunities in that regard. Growth can also come from kind of changes to the supply side. So you mentioned we've got strong employment data. We've actually in Scotland still got, I think we're about 40 or 50,000 more people in PAYE than we had pre-COVID. So there's people in employment, but what can also drive that in a sense is policies like supporting childcare, getting more people working in the labour market. And I never really mentioned this in my slides, was the inactive in the economy. COVID, we've seen older workers leaving the economy due partly to COVID. We have more kind of longer term sick. So anything that can activate that supply side and bring labour back in will support growth as well. Really important, just the outlook, and for sectors to think about what are the opportunities. The external environment is obviously linked to that for trade. We're obviously in different trading arrangements now, but the external environment, inflation will come down. We've already seen it in the US, much reduced, seen it in Europe as well. So those trading opportunities will come. And the UK is relatively, and Scotland, competitive in terms of the exchange rate, both for investment coming in and for selling overseas. So there's a kind of demand side element which will be squeezed a little bit through the period we've came through, but it's really the supply side that we tend to think about. Thinking about skills, enterprise, innovation, kind of investment, how we can improve regulation, planning, and make sure that we are able to bring the investment into the economy that will leverage the private sector investment. The government's focused a lot around a new deal for business, being clearer on the cumulative impact of regulation in sectors. I mean, we're in a period of transition now. The previous government economic strategy was really talking about the National Strategy for Economic Transformation over 10 years to meet our climate targets, to address some of the nature issues that are there, the demographics, the technology changes, is going to mean a lot of change. But change creates opportunity as well, and there's opportunities within that to grow the economy and change and provide opportunities for business. Probably in 10 years' time, when we look back at this period, people will then see the extent to which actually business models did change. I bet when we look back to the 1980s, where there's a big period of restructuring. So growth is low at the moment. That's why it's the focus of both the Scottish UK government to try and kind of build that growth back and build the confidence in business resilience.
Okay, thanks. We've got one more question. We're very limited on time, and I think it's you answered it a bit there as well, but just about the productivity problem we've got in Scotland and across the UK. How do we address that as a long-term issue in 60 seconds?
Yeah, so productivity problem, we've seen productivity kind of grow, averaged about 1.5, 1.6% up to the financial crisis. Since then, both Scotland and the UK grown about 0.91%, so really low. From a business perspective, business investment's low in the UK, low in Scotland, so we get more business investment. How you use skills, utilisation of skills, innovation, it's all about business models and kind of driving that productivity from the micro up the way. And with stable macro conditions, then we'll see productivity coming back.
Okay, thank you very much. Thanks, Gary, for that.